Welcome to Pride Partners International's monthly webinar. Thank you for joining us today. Pride Partners International is a global partnership of firms and specialists in transfer pricing and financial valuation. The association is the meeting ground for professionals capable of facing a challenging business environment, helping them connect to boost their continuous professional development and enhance their technical and human skills and abilities. This partnership is made up of experts recognized by their trajectory and prestige in the transfer pricing and financial valuation fields. Experts that constantly participate in the exchange of technical information, knowledge development, and implementation of global best practices. When a firm joins the PPI partnership, it increases its scope immediately and exponentially. Business becomes much simpler by accessing training, technology, resource optimization, and new business opportunities, among other benefits. We invite you to learn more about Pride Partners International. Contact our agents and be part of the global elite of transfer pricing and financial valuation consulting. Our transmission will begin shortly. We invite you to participate actively by sending all your questions or comments through the live chat. Again, thank you for watching, and we hope you enjoy the event.
Hello everyone, thank you very much for joining today's webinar. My name is Julia Vasconcelos. I'm an attorney. I have an LLM based on intellectual property, and I work with Edgarstat as a senior consultant. I've been working with Edgarstat for the past 16 years, and for the past 10, I've been primarily engaged with our consulting projects and with our company financials databases. So today we are going to be covering the topic of how to create defensible transfer pricing reports, and we'll discuss the best ways or the steps to characterize a tested party, select comparables, and determine a reliable arm's length range. Before we go to the slides, I would also like to thank Pride Partners International for inviting us to participate in this webinar series. We've been partners with Pride Partners International for a few years now, and it's always a pleasure to participate and to contribute to these events. So, starting our first topic for today, it's always good to remind ourselves of the transfer pricing principles. What are the cornerstone principles that guide transfer pricing today? So we know that the primary principle is the arm's length principle. And the arm's length principle is present in both the US Treasury regulations and also in the OECD guidelines. So throughout my presentation, you will see reference to both legislations or to both set of rules that are the primary rules used today in transfer pricing worldwide. We know there are several countries that are not members of the OECD, but to different extents adopt the OECD transfer pricing guidelines, and either by reference or create legislations that make reference and that incorporate these same principles to their internal laws or regulations. So, talking specifically about the arm's length principle, we see that the arm's length principle refers to the fact that a transaction that is done between parties of a same multinational group needs to have consistent results with transactions that would have been obtained or with results that would have been obtained for the same transaction under the same circumstances or between uncontrolled taxpayers. So we're talking about comparing, and the arm's length principle is defined both in the US regulations and in the OECD guidelines using comparable transactions. So we're talking about looking at a scenario in which you have controlled or related parties and comparing and trying to find parity. And of course, the objective is to find tax parity between uncontrolled taxpayers and controlled taxpayers. In the OECD, we have a reference to paragraph 1 of Article 9 in the OECD Model Tax Convention that again makes reference to two associated enterprises, their commercial or financial transactions that need to be comparable with the independent enterprises transactions. And we see that being followed or being corroborated also in the 2017, which is the latest OECD transfer pricing guidelines, where the OECD already talks about adjusting the profits of associated enterprises to those that would have been obtained by independent enterprises in comparable transactions and comparable circumstances. So we understand that the arm's length principle is defined based on comparables. So our primary objective when we are doing a transfer pricing analysis is to understand the transactions that are done between the multinational enterprises that are associated, so that are related or that belong to the same group. These are all synonyms that we can use to refer to the same structure. And those transactions, either the transaction itself, if we can find comparables at the level of the transaction, or the profit obtained from such transactions, need to be comparable to those of independent enterprises or unrelated parties. Based on that, we see that several multinational enterprises create structures that would describe their intercompany transactions. We know that there is a presumption of base erosion and profit shifting when there is an analysis from the tax administration of the multinational enterprises intercompany transactions. So these companies, these multinational enterprises, these MNEs, they need to provide and they need to prove that their intercompany transactions have a business purpose. Their intercompany transactions have economic substance. So this is the first hurdle that we have to pass before we begin an transfer pricing analysis of the intercompany transactions. So the question is, do the transactions between these related parties have economic substance? And to have economic substance, they need to have a business purpose, and it's not only to save taxes. And in this context, we see references of another principle, that is the substance over form principle, in which we see how important facts are for the transfer pricing analysis. Because on the substance over form principle, we see that the greatest weight will be given to the actual conduct of the parties. And the tax administration may disregard the structure adopted by related parties if they are inconsistent with the economic substance. So we see that facts are very important. So how the tax administration analyzes, it's not bound by the legal terms, it's not bound by the contractual terms, it's not bound by how the international groups describe their intercompany transactions, but the analysis must be driven and must be guided by the facts. I bring for you today a case study that we'll be using for the specific topics of today's presentation. So in this case here, you see on a very simple organizational chart, we know that intercompany transactions have become more and more complex with intangible licenses, provision of services, special purpose entities, permanent establishments, and the topics of transfer pricing are endless. But to simplify matters, I brought today a very simple case in which we have a US parent that is a manufacturer of chemicals, and these companies exports chemicals to its Swiss subsidiary. That's a distributor that will then sell the products to unrelated customers in the EMEA markets. So what are the steps necessary to create defensible transfer pricing reports? So we need first to select the tested party, second, to select comparables, third, to select the most reliable transfer pricing methods based on the information that's available, and fourth, to select the arm's length range of the consideration. In this case, that's going to be paid, the amount paid by the Swiss subsidiary for the products, these chemicals that are being sold and exported from the US parent that's a manufacturer. So let's go to the topic of characterization of the tested party. How do we select the tested party, and what should guide that type of decision? So the US Treasury regs and the OECD guidelines talk about selecting the tested party or selecting the entity that's the least complex. And the least complex has the less functions or does not own valuable intangibles or unique assets that would distinguish or that would make that entity very different from the potential comparables, the potential uncontrolled comparables that we could find for this specific transaction. So what are the questions or what are the facts that we need to analyze to understand, to select the tested party, but also not to make false claims or not to make naive claims with regards to the characterization of this entity. So we often see that transfer pricing reports classify entities as limited risks, limited functions, and having limited assets. But those claims need to be supported by the facts and the structure of the intercompany transaction, the functions performed by that entity, and also the financials. So we've all heard about the DEMPI activities from the OECD guidelines that talk about the development, enhancement, maintenance, protection of intangibles. And that is part of the analysis, because if an entity performs a lot of what's described as these DEMPE functions, it cannot be characterized as a limited risk. It may be eventually selected as the tested party because, in contrast, the other entities involved in such transactions may be more complex, but then we would not see a routine risk or a routine profit only attributed to that particular entity. We also need to pay attention to the financials of this tested party. So we know from the same examples that risks follow functions and assets employed. So if we see from the financials that any particular entity has cumulative advertising, in the case of distributors, or has cumulative research and development expenses, that entity may be classified as owning intangibles or developing intangibles and thus not having limited functions. The same train of thought we can apply for payroll. So if we're claiming that a tested party is a manufacturer, like in this case that we're using for today's presentation, we need to see payroll in that company's financials to substantiate and to support the manufacturing functions. The same thing that we apply for assets. It's unlikely that you'd have a chemical manufacturer that doesn't have a factory, that doesn't have property, plant, and equipment in its balance sheet, that doesn't have a substantial amount in cost of labor. And of course, the analysis or the lines would vary depending on the intercompany transaction that we're analyzing. So for instance, for service providers, we would not expect a lot in cost of goods sold for cost of labor, but we would expect more under salaries and wages. And so that is very important for us to analyze and for us to keep in mind that whenever we make a claim that we're selecting a tested party that is the least complex of the controlled taxpayers, and eventually if we're going as far as saying that that tested party has limited functions, risks, and assets, that the financial data corroborates and supports this analysis. We also see that on inbound and outbound payments. So if we're claiming the entity does not own any intangibles, but when we look at the financials, we see that it receives royalties. We need to justify, we need to understand why is that entity receiving royalties. It's receiving royalties on behalf of someone else. Why is that? Is it paying then again to another entity in the group? Or is this in fact the economic owner of the intangible and it's receiving the return for the use or the exploitation of that intangible? So it's very important that we keep that in mind. And we also saw from multiple transfer pricing cases that were litigated recently that the characterization of the tested party was a point of controversy, was a point of contention in which the M&E, the multinational enterprises, and the tax administration during the litigation did not reach an agreement on how to characterize the tested party. If it's a limited risk function and limited function or limited risk entity, or if it's a value-added distributor, a supplier who owns the intangibles. So that all goes through the characterization of the tested parties, and it has been a point of controversy in recent litigation cases. Going to our second topic on the selection of comparables, we list of comparability factors. And there are 5 primary comparability factors, and each of them apply to at a more or a less extent depending on the transfer pricing methods that we apply. So we know that the highest level of comparability is required if you apply the CUP or the CUT, the comparable and control price or the comparable and control transaction. And for that particular transfer pricing method, the most important compatibility factor would be the characteristics of properties or services and the contractual terms. If we're out of that scenario and we are in the scenario that is the most used transfer pricing method in the world today, that is the transactional net margin method, or the TNMM under the OECD guidelines, or the comparable profits method, the CPM under the US Treasury regulations, the greatest weight is given to the functions performed of the tested party that needs to be comparable to the companies that we're analyzing and selecting as comparable to determine the profitability, the arm's length profit. So the functions performed work together with the risks assumed, work together with the economic conditions. And these are the five primary factors that we see in both the OECD guidelines and the US Treasury regulations. But we know that each one of these factors are divided into sub-factors. So it's like you open a drawer, and inside the drawer you have several files that continue giving you details on what needs to be analyzed and what entails saying that the functions are comparable or that you have similar economic conditions. And this can become, the analysis can become subjective and subject to qualitative or judgment factors. And both the Treasury regulations, the US Treasury regulations and the OECD guidelines do recognize that transfer pricing analysis, there is judgment involved in the transfer pricing analysis. And there is no harm in using judgment, provided that we are consistent and provided that we can support the analysis and the decisions that we make during the process. So how we can do that? How can we create defensible transfer pricing reports, and how can we, using judgment, support our decisions? So in addition to the step that we already covered of selecting carefully the tested party, we also need to use a robust search criteria. So here I'm using Edgarstat as an example, our company financials database with publicly traded companies worldwide. And using our example of manufacturers of chemicals, I have selected here 3 SIC codes that are closest to the functions performed by my selected tested party. So you see that they all have the same beginning, so they all start with 28, which reflects the manufacturing of chemicals. They differ in the two other digits for the SIC code, and so the products may differ a little bit. But since I would be applying the TNMM in this case, the products are not as important as the functions performed. But please note that I did not mix SIC codes of manufacturing and service providers or distribution. And that's very important for us to pay attention, because we need to select the primary function and the material function of the tested party, or select the SIC code or the function that is reflected in the transaction that we're benchmarking. So mixing manufacturing and distribution, mixing manufacturing and the provision of services may create problems for us with tax administrations, and may need additional justification as to why you would mix the transactions under analysis. And we even see that from the structure of the US Treasury regulations and the OECD guidelines, in which you have different sections for tangible goods, for the transfer of tangible goods and how a manufacturer is classified, or what's important to analyze in a distribution transaction, and a separate analysis for the provision of services. So that's important for us to keep in mind and take into considerations. Other factors that we have here that are important are the country, and we saw from the slide before that geographical location is a relevant factor, is a relevant comparability factor. So the closest we can get to the jurisdiction of our tested party, the better, pending, of course, availability of data. We also have here the use of multiple years, and again, the standard is that you use multiple years, and so that you cover an inventory cycle, or that you cover the economic cycle, and you do an analysis not under the spotlight for a single particular event or a single particular year, but that you can take into consideration and accommodate fluctuations that are natural and that are natural to the market and that are independent of management's decision. So the idea is that you select multiple years and you consider from peak to peak or from trough to trough. In this case, I selected 3 years, but there is no rule that would say specifically 3 years. It can be 4, it can be 5, it can be 10, depending on the scenario and the industry that you're analyzing. We also have here 2 criteria with regards to the financials. One is with regards to revenue. Our tested party is in full operation, so we want our comparables also to be operating in all of the years that we're analyzing, so the revenue needs to be positive. And we have a second one about operating profit, in which there is arguments to be made, but in principle we would select companies that are profitable. We remember that we talked about there is a presumption of profit shifting and base erosion and profit shifting when we talk about intercompany transaction. And so losses would raise suspicion with the tax administration. Of course, we go through periods of economic recessions, wars, or shortages of material, pandemics like the COVID-19 that we're facing. So losses are part of ongoing businesses, but when it comes to intercompany transactions, losses need to be justified by factors and matters that are outside the control of management, and we can find that support in the data available for the comparables and also for the tested party. So I chose this search criteria, and I can show you, I ran a search and I found comparables for this fictitious tested party, and I'm also analyzing the financial information that I have available for the comparables. So we know that in transfer pricing there are several transfer pricing adjustments that are proposed by practitioners, and there are several data that needs to be analyzed from the comparables. So as I mentioned also in the beginning, in this case, my tested party is a manufacturer, and I have classified that as a limited risk entity. So it does not have substantial R&D expenses. So I can use one of the diagnostic ratios that I have available here in Edgarstat, that is R&D expenses over revenue, to check if the potential comparables that I'm analyzing have or not significant R&D expenses. And if they do, and my tested party does not have, then I can reject those companies. There are also analysis to be done on the level of working capital, and we have that by default in our database. We know that this is a very common adjustment, but we also say all adjustments need to be tested, so that when you do it and when you propose it, you can support your decision and you can claim that the adjustment is done to improve the reliability of your results and to improve the reliability of your range. We can also go to annual reports that are published by publicly traded companies. And in the cases of jurisdictions in which privately held data is used or is accepted, it's very important for the analyst to take into consideration and to look at the information that's available for that company in particular. Are you able to ascertain the functions performed by that company? Are you able to ascertain what is the accounting standard that's being applied? Is it US GAAP? Is it IFRS? Is it local GAAP? Can you compare those financials between the group of comparables that you're analyzing and that you'll end up accepting to calculate your arm's length range? So when we're using publicly traded companies, we have the security of relying on annual reports that are audited and that are published on stock exchanges around the world. And there are several factors that we can consider, and we also like to point to the analysis of accounting footnotes that are very important. Sometimes a company will report under an SIC code, but it would perform multiple functions. And how do we know if any of additional function is material and will have an impact on the profitability of that company and would end up making this potential comparable not comparable to our tested party because our tested party is a limited function entity? So for instance, we can go to the accounting footnotes and look at segment information. In this case, we see that this company has 3 reportable segments. Below here, the screen, we would also see that they have different geographical areas, or they sell into different geographical areas. That's important for us to analyze as well. There is revenue recognition, in which we can find information about what's the operation like for this company. How do they recognize revenue? So these all tie up to those 5 comparability factors that we mentioned a few slides ago, into determining what is the functions performed by these comparables, what are the risks assumed, what are the economic conditions in which they operate, what are the assets employed, so that we can make a sound comparability analysis and we can accept and reject these, but we can also support our decision. So in Edgarstat, we have the ability of online doing an accept and rejection of the companies. You can select functions, you can select rejection reasons, and you can provide comments. So providing comments is important to substantiate, to support our decisions, and it also serves as a guide. So that we would follow and we would apply the same standards to all of our comparability analysis. So often what happens when I'm doing a comparability analysis is that I start reviewing the annual reports and I find some information, like in this case, I found that this company has significant revenue from the provision of services, and my tested party is primarily a manufacturer. And it reminds me that I did not look for that particular information from prior companies. So it's important that we narrate. It's important that we provide support to the decisions that we make, and that we apply that same standard to the comparability analysis of all the companies that we're looking for. So now right away, provide comments and make sure that you apply the same standards to all of the analysis that you make. Now, moving to our last topic of today's presentation is to talk about a reliable arm's length range. So we have the definition of the arm's length range, and we calculate an interval of the profitability of the comparables that we selected. And if the taxpayer, or if our tested party reports a profit that's inside such arm's length range, it's not subject to an adjustment. So it's already reporting through taxable income. It's already at tax parity with uncontrolled enterprises. But if the results of our tested party fall outside that range that is produced from the comparables, then the tax administration is entitled to make an adjustment. Most practitioners and the OECD guidelines mention quartiles, the US regulations mention quartiles, so they say that the quartile ordinarily provides an acceptable measure of the arm's length range. However, we need to pay attention that the arm's length range, same as the comparables, we need to apply the principle of reliability. So the most appropriate arm's length range would be the most reliable statistical interval that we can find from the comparables that we selected. So we see references in both the US regs and the OECD guidelines that other statistical intervals may be applied if they are more reliable. I understand there are some jurisdictions in which they did not incorporate this part of the OECD guidelines and that they're explicit about using quartiles. Then if that's the case, we go with the quartiles. There's no questions to be asked. But we know that most of them do not make this restriction, and some analysts may not be aware or may eventually forget about the analysis of reliability on the statistical intervals. So often we see that the interquartile range is too wide to be practical. And we see a variation in a distance between Q1 and Q3 that's too high. And although there is this idea that maybe using a wider range is beneficial to our tested party, depending on the base, claiming that an arm's length range can vary 11 percentage points may also be unpractical, because you may say if it's a 2% is inside the arm's length range and a 10% is also inside the arm's length range, and you're talking on a base of billions of dollars, the assessment can vary quite a bit. So in Edgarstat, we provide the ability for you to compare the statistical intervals, and you can use other statistical intervals to test the reliability of the interquartile range. So we have other options such as the notches for the median, confidence intervals, and even sophisticated or more sophisticated regression analysis. So in the case that I selected today, we did a comparability analysis, selected 10 comparables. Here you see the count at 30 because we have one observation for each one of the 3 years under analysis. And you look at this box plot and it's pretty. It has a normal distribution. You see that the median is very close to the middle of the box. And here will be the Q3, here will be the Q1, the median is right in the middle, so it looks pretty, it looks reasonable, it looks reliable. But when you analyze the numbers, Q1 is 11, and this is the markup because we're talking about the manufacturer. So Q1 is at 11.5, but Q3 is at 23. So claiming that this distance is reliable and that the arm's length range can be, or that the arm's length profit can be anywhere inside this number is too wide to be practical and may increase the liability and leave an exposure of the tested party that is unwanted. So what we offer is the ability for the analyst to compare. So you see that we have the interquartile range, but we have a much narrower range here using the examples for the notches. So instead of varying from 11 to 20 something, we now have a variation between 14 and 20 that's much narrower. The median is still the same because we're using the notches for the median, so the center is still the same. But as I said before, if the taxpayer falls inside the arm's length range, any point inside doesn't need to be necessarily to the median. It's not, there is no adjustment. If it's outside the range, then there's an adjustment to be made. So we need to pay attention to the reliability of the arm's length range and to the use of different statistical intervals to make our analysis sound and to resist scrutiny. So coming to the conclusion of today's presentations, so there are a few takeaways that I would like you to mind after this presentation. The first one is about characterization of the tested party, the selection of comparables, and the determination of the arm's length range must follow transfer pricing principles and survive audit and litigation scrutiny. So it's very important that as we go through from the beginning to the end of the transfer pricing analysis, we keep in mind that someone else will review the analysis, and the analysis needs to stand on its own and needs to survive audit and potentially litigation scrutiny. The comparability analysis must be based on facts and data, and rules of thumb or best practices that are not supported by the data or that are not supported by academic principles should not be used in transfer pricing, or for that matter anywhere in science. And the third one is that available data must corroborate the decisions that you make. And that data must be applied, or the standards and the analysis and the criteria that you utilize must be applied to both the tested party that you selected and the comparables. So it's the same standard to apply to both, because at the end of the day, they need to be comparable. And so the tested party needs to follow the same standards and needs to have the same characteristics and the same comparability that you selected for your comparables. The fourth one is that arm's length range is not limited to the use of quartiles. The regulations and the OECD guidelines allow for the use of other statistical methods, provided that they are more reliable. And at the end of the day, support your decisions with facts, test your results, use the available data and the available tools that you have at hand to create defensible transfer pricing reports that will survive audit and litigation scrutiny. So that concludes our presentation today. Thank you very much for your time, for your attention. Right here you have my email address. If you have any questions, we'll be replying to them shortly. If I eventually don't get to your question, We will follow up with you via email if you leave and you authorize us to have your contact information. Anything else, please feel free to visit us at edgarstat.com and to send us an email. Thank you very much for your attention today, and have a great day.